Hello, everyone. Felipe here. Happy Monday. Hope everyone is doing good and had an awesome Cinco de Mayo and didn't drink too much tequila. So, as you know, I'm here to keep you guys up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So, I'll go ahead and jump right into it. So, I've been seeing some interesting things lately in the market, which is kind of funny, actually. There's which these have been ongoing, these meme coins where people are just basically speculating and trying to get rich in a matter of weeks, which that's never a good thought to begin with. The most recent one is Pepe Coin, which is basically a coin based off of a frog. Yeah, it sounds as ridiculous as it is. So this coin, at 2 weeks after its release, basically went up 5,000%, which is kind of crazy. So I find it interesting because it just shows that there's still speculation in the market. And at the end of the day, that's not a very good thing over the long term because it usually leaves few winners and a lot of losers because most of these coins are literally rug pulls, basically pump and dumps, right? Which if they were regulated, these would be completely illegal. But as since they're not regulated, people get away with this stuff, right? They're literally scams and Ponzi's. So basically, um, these meme coins keep popping up out of nowhere, which in reality, these meme coins are created by some programmer somewhere. They're basically written code. In reality, you can learn in a couple of hours or following a YouTube video or something how to create one of these coins yourself. And basically, there you go. You created one of these tokens. That's literally what they are. So this one has been really hyped up recently in terms of like trading volume and so forth. And I find it funny when they use the term investor in these kinds of things because I don't even know what to call them in reality. So there's a surge in trading volume is an indication of growing community consisting of active day traders and investors alike. I don't understand why would you use the term investor in something like this. I find that like ridiculous. Day traders and well, in reality, speculators, because day traders in reality are speculators, right? No one knows what the market's going to do day to day. You can get lucky. Technical analysis and all that, in my opinion, is basically good for like historical data, but doesn't really in reality tell you what's going to happen in the future or in any given moment. So Pepe Coin, um, according to this article, might hold some promise for the future. Again, they use the term some investors. It makes me cringe when they use the word investor with these things. These are pure speculation. Already on the prowl for promising projects like Pikamoon, another one of these pump and dumps, which supposedly Pikamoon is this coin where people are gonna earn over playing a video game. Imagine you can earn um coins that have some sort of value playing a video game. That sounds crazy to me. Here they're basically driving FOMO. It's speculated to generate over 10,000%. I don't know how this stuff is legal and how they're able to even say these things, but they do. Trying to create FOMO before the release of these so-called meme coins, which in reality are 100% pump and dumps, no different than all the other ones that have been in the market. So it's just crazy to me to see that still a lot of speculation in the market. And a lot of this is due to a lot of these TikTokers that in reality don't know what the hell they're talking about, and these YouTubers that are literally just pumping these coins to try to make a quick buck before they ultimately collapse, right? And a lot of people are left holding these useless coins that in reality have no tangible use or no tangible value. I actually was reading into one of these where a guy turned something crazy like $27 into a ton of money on this specific Pepe coin and couldn't sell it. Could not sell, could not get out of the coin. So what's the point of a massive unrealized gain that you cannot sell for money, right? It makes no sense. In reality, what these are just doing, they're making the crypto currency brokerages such as Coinbase, Binance, and so forth a ton of money via gas fees, which is the crypto lingo for transaction fees, because they're overinflated at this current time due to all the speculation in these ridiculous coins. On another note, because there's a narrative out there that basically Federal Reserve is going to pivot or they're going to pause and so forth, which in reality, no one knows what the hell the Federal Reserve is going to do. Sometimes they don't even know what they're going to do. At least that's my assumption from reading biographies from people such as Ben Bernanke, Paul Volcker, and so forth. Typically, they always say they do their best in what they believe they should be doing, but in reality, they never know what they are going to do or the effects of what they are doing are going to have on the overall economy, right? And in this case, the United States, the global economy, right? So in this case, Fed Bullard, which is one of the board members of the Federal Reserve, advises, just as Jerome Powell, that they're going to be taking it meeting by meeting in terms of that there's the decisions they make whether to continue hiking rates or not, but that they're going to do it based off of data dependent information that comes in from then to now or from now to the future, right? Data dependent information, basically economic statistics such as the unemployment rate and of course the CPI, Consumer Price Index, which is the inflation meter. So here, basically, Bullard goes into saying that they're taking a data-dependent stance. He's taking a data-dependent stance of his colleagues after a year of urging them onto consecutive rate increases. Bullard said he felt the benchmark policy rate will ultimately need to grind higher because he anticipates slower progress on inflation. I am willing to be data dependent and not prejudged. Basically, they're going to be watching economic indicators to assist them in making their decisions whether to continue increasing rates, which based off the data that has been coming in, it seems that they are, because that's what they're saying. They're going to watch the data, and depending on what the incoming data reveals, they're going to take it meeting by meeting on their decisions. So Bullard said he felt the 5% to 5.25% level reached this week, which is the Fed rate, which is currently, I believe, 5.25%. Considering in 2020 was near, and 2021 near zero, it's gone on ridiculously fast, gone up. So he believes levels reached this week was still only at the low end of what might be needed. His own projections have suggested rates may need to move up another half point to put inflation on a steadily downward path. He goes on saying April jobs report shows that unemployment rate at 3.4% and an additional 253,000 positions added to payrolls, which is, again, not what the Federal Reserve wants to see. They want to actually increase the unemployment rate in a way of fighting inflation, right? Because if they increase the unemployment rate, less people have money to spend on consumer discretionary goods, and that is a way of them fighting inflation and bringing prices down. So I'm willing to look at data and see where we are when we get to the next meeting on June 13th through 14th. So as another Fed official is basically advising, they're data dependent. They're going to see what the incoming data is. Based off of that data, they're going to decide whether to increase rates or not. So basically, recently, the unemployment rate report came out on last Friday, May 5th. Came out hot, 3.4% unemployment rate. That means a lot of people are basically means the labor market is still strong. Not what the Federal Reserve wants to see if they want to pivot and come down on rates. They advise that as long as the labor market is strong, they're going to continue increasing rates to fight inflation. So it's interesting what the CPI index is going to print next week, which I believe it comes out next Wednesday, May 10th at early morning before the market opens. But here we're getting the data that they're looking for, and it's coming in hot, which is basically, you would think unemployment rate being low is good news, but in the Fed's eye is bad news, because it just means that based off of what they're saying, they're going to continue increasing rates. And on another note, with all the craziness in the regional banking sector, there's talk about a potential prevention by there's like a narrative going on about potentially preventing short sellers from selling short bank stocks, which the last time that occurred sparked the 2008 market decline. It literally caused fear in the market, and during the 2008 crisis, when the SEC stepped in and banned short selling of bank stocks to kind of prevent the mess that was going on, right? So here there is basically just speculation going on, but despite worries over bank soundness hitting share prices, the SEC official said on Wednesday that the agency was not currently contemplating a short selling ban. U.S. officials at the Federal Reserve and state level are, however, looking into the possibility of market manipulation behind the significant fluctuations in banking shares prices over recent days. Not so much of a free market if you ban short selling, because it is part of the free market, right? I can see how this can potentially, if they do decide to do that, be negative in terms of a catalyst, because during the 2008 banking crisis, when they banned short selling, it literally sparked fear in the market. So curious if they do decide to do this at some point in the near future, if it does, reignite that fear that happened in the past during a similar situation. So basically, they're saying they're investigating market manipulation in terms of the regional bank sell-off. One thing that I can think of that I recently read about is Western Allegiance or Alliance Bank, where a report by Financial Times came out saying that they were looking for a buyer to take over their bank, and it sparked a sell-off in that specific regional bank. In that case, I guess that is a sense of market manipulation if someone is putting out false information and sparking fear in a specific company to then their stock price sells off dramatically. On another note, some interesting things I've been seeing, which let me swap over here quickly, which is just some charts I find very interesting, and I kind of want to run by you guys quickly. So here we have some very interesting charts, right? Basically, interest rates, or the Fed funds rate, which is in reality the only interest rate that the Federal Reserve controls, right? They control the federal funds rate, and by proxy, all other interest rates are affected, right? So here we have a chart going back quite a while, 1915, of where the Fed funds rate basically was during that time period. So here we see that throughout any hiking period of the Federal Reserve, they typically cause some sort of market panic or problem in the overall market, which then leads to sell-offs, right? So you can see over here in the nastiest market crash in history as per market declines, 1929 market crash. Fed funds rate was around 5%, which is a little over 5%, which is basically where we are heading to, it seems like, at this current time. And then again, of course, 1974, 1982, which was basically after the oil crisis that occurred back then, rates went ballistic. That was during the time that Paul Volcker was the Federal Reserve chairman. And here again, dot-com bubble, rate hikes were going up. 2007, which then sparked the subprime mortgage crisis. Rates were on an upward trend until, of course, the crisis occurred. And then here in current time, we see rates going slightly above 5%. And we're already seeing issues with the regional banks. A lot of regional banks have gone bust and have had to be acquired by bigger banks. And that doesn't necessarily mean that the bad assets that these banks were holding just are no longer an issue. Now these bigger banks are holding on to the big paper losses that the regional banks they acquired had, right? Which this is another interesting little picture here. The recent banks that literally went under had more, the value of the assets were much larger than those that went bust in 2008, which I find it very interesting, considering that the banks that have recently gone under seem to be much larger than the majority, or not the majority, but most of the banks that went bankrupt in 2008. It's just interesting to see this as a terms of size comparison, right? First Republic Bank, $229 billion in assets. Silicon Valley Bank, $209 billion in assets. Signature Bank, $110 billion in assets. One of the bigger banks that went bankrupt during the 2008 crisis was Washington Mutual Bank, $307 billion in assets. So that just gives you an idea of the size of these banks that have recently gone under. They're not small banks. They're freaking massive. Really, really big banks. So it's interesting that a lot of the companies that acquired, well, JP Morgan acquired First Republic Bank, but the bad assets that First Republic Bank held are now property of JP Morgan. Interesting situation. Don't know where that might lead, but those bad assets haven't gone anywhere. They've just been acquired by a larger institution. So on basically on this note, which I like this, something that I learned from reading the book by Robert Shiller, Narrative Economics, where narratives are very powerful, right? And the narrative trends that I've noticed recently is, which have been ongoing for a while, is basically buy the dip. Every time the market declines, buy the dip, buy the dip. That's the narrative that is being pushed, right? And then the narrative that the Fed is going to pivot. I don't understand where that keeps coming from. They have advised, and they've even stated in the last meeting, that they are not going to pause and that they're going to take a data-dependent stance, which, as we've seen, the data continues to come in hot, literally stating that it's going to force the Federal Reserve to continue to, at least for the short term, increase rates, which the Fed funds rates currently stands at 5.25%. It has not been at these levels since 2007. So that's an interesting thing to see. And then, of course, this time is different. This time is different. I guess this time is different in a sort of sense, considering credit card debt and in reality, national debt is larger than ever at a time where rates are going up. So that's an interesting combination, right? Which, in my opinion, and then me speculating, I feel like in some point in the future, I don't know when, is going to be the end of a large credit cycle, which are typically the nasty economic declines. So with some of that, I'll leave you guys with a market quote, which I like. Bulls and bears make money, greedy pigs get slaughtered, and disciplined pigs get rich. And a little bit of market knowledge. When a man who ought to want a stock does not want it, meaning insiders, CEOs, etc., why should I want it? I figure that no matter how prosperous other automobile companies might be, it was a cinch to sell Chester short. Chester being a automotive company during the early 1920s. Experience has taught me to beware of buying a stock that refuses to follow the group leaders. This is a quote from the 1940s by Jesse Livermore. He basically states that he liked to short the industry laggers, so companies that lagged behind industries, the industry's leader, basically. Same industry, other stocks are going up in price, yet that specific company is not following the others in the industry. So I like that because it puts things into perspective. So with that being said, thank you guys for watching. I hope I shared some good information with you guys, and I hope you guys have an awesome week, and I'll see you guys soon.